Good evening, everyone. Time for another silver update. This is the Euro US dollar cross, and that's laid over the silver chart provided by netdania.com. You can click on the link below. We're on the 15-minute chart. You can see here in the price of silver, we were drifting higher. Well, we were drifting lower in the euro, whereas the price of silver was going higher, getting ready to do a breakout. And then, of course, then this news announcement came out of this coordinated interest rate cut. And you can see the story here. Three central banks take action in sign of alarm. Beijing, Frankfurt, China, the Eurozone, and Britain loosened monetary policy in the space of less than an hour on Thursday, signaling a growing level of alarm about the world economy, although suggestions of coordinated action were played down. If you believe that, I got a bridge I'd like to sell you. Of the three, the surprise move was from Beijing, which lowered its lending rate by 31 basis points to 6% following an interest rate cut just a month ago that also came out of the blue. The European Central Bank cut rates to a record low 0.75% following a dire run of economic data, but it steered clear of bolder moves such as reviving its government bond buying program or flooding banks with more long-term liquidity. Still, a Reuters poll found ECB is expected to follow the rate cut with more steps to help the region's economy. The Bank of England, whose rates are already a record low 0.5%, said it would restart its printing presses and buy £50 billion, $78 billion of assets with newly created money to help the economy out of recession. Does any of this seem bearish for silver? We'll talk a little bit about that later when we look at deflation. Quote, "It is a surprise that they're moving so quickly. It shows that policymakers' concerns about the global economy have only grown," Mark Williams, an economist at Capital Economics in London, said of the People's Bank of China action. No coordination. In Frankfurt, ECB's President Mario Draghi denied any globally coordinated central bank action of the sort seen after the collapse of Lehman Brothers in 2008. Quote, "On coordination, no, there wasn't any. That went beyond the normal exchange of views on the state of the business cycle, the state of the economy, and the state of global demand," he told a news conference. Asked if conditions were now as bad as they were in late 2008 when the world's financial system was teetering, Draghi replied, "Definitely not." So let's take a look here at a chart of the Fed funds rate, and this is the Fed funds rate, all data. This comes from the Federal Reserve Bank of New York, and you can see here on this chart that the Fed funds rate dropped late in 2008 to nearly zero. We're talking between 0 and 0.25%, and it went straight from 1% straight down there. So, you know, the ECB just cut to 0.75, so this is their cut, the equivalent of this cut that we had back in 2008. And you can see they've been pegged at basically zero ever since then. So how is it that Mario Draghi can claim that things aren't worse? If things weren't worse, then these rates would be rising. So things are not getting any better, and arguably they're worse. Now you can see this time frame here. This was the Bush recession, which lasted from January of 2002, at least according to the interest rates, to they started raising then in June of 2004. So this one has now dragged on longer than anything before it. Of course, we've never been at zero before either. So Just looking at the interest rate alone that the Fed sets, the Fed funds rate, it would seem that we are actually in a worse situation than we were in 2008. And that's going to take us over to the question of the night. Now, a lot of people are going to ask, well, why would silver drop on an interest rate cut? Isn't an interest rate cut, looser money, more bullish for silver? Well, you'd think so, unless it means that it's an admission that things are much worse than they were, or that they're thinking. So it's kind of a two-edged sword. You can take it either way. That's very common with market reactions to interest rate cuts. Normally, the bulls start to come out for stocks and other markets when they do the last cut. In other words, when they cut interest rates and they give an indication that that will be the last one, in that the rates will rise the next time they meet. So that's implying that there will be growth. So sometimes it's hard to figure out which way to bet on these interest rate cuts, but clearly a cut in interest rates in Europe does not portend a tremendous drop in the price of silver. So I think it's pretty clear that this was not just happenstance, but coordinated action. And it just so happens that if we'll get out here to the price of silver, because we had been charting those trend lines, it just so happens that this is the point where we had touched up against a very key trend line, you can see. And it was right at that point when the bankers got together and made a quick announcement, and then we had this big old sell-off in silver. You can see that the volume was very large. The volume started spiking up around 7 a.m. Then about 7:45, that's when this cascading sell-off occurred. And you can see, if we pull out to, say, the 30-minute chart, that that was significant volume, at least for the last few days, at least as significant as we've had any other day. So once again, they've taken silver to the woodshed. It's pretty obvious now that it's the enemy of the central bankers, and they're going to do everything they can to keep silver down as long as they can, silver and gold. And we'll see that when we look at Jim Willie. Let's go over to the question of the day real quick here, and this is about deflation. This is from Silver Hedge. Gold and deflation. Hello, Brother John. I've been following you for quite some time now, and today I registered an account with you so I can ask you a question. I'm very thankful for all the research you do in the silver community, and myself and my life is very busy. I cannot keep up with everything that you make it very easy to do. The only silver site one needs. Thanks for all your hard work. I totally understand that with inflation, gold prices and other commodities will rise. My question is, I hear the argument that gold will fall in a deflationary environment, and I have also heard the argument that gold will rise in a deflationary environment. Which of these scenarios is true? I have difficulty comprehending the rise of gold in a deflationary scenario. Doesn't deflation mean higher interest rates, meaning less dollars to throw at gold, or gold valued less because of less dollars in circulation? Your insight is much appreciated. Thanks, fellow Christian brothers. So, well, there are a lot of complex ways you can look at it. I like to just keep it real simple. Gold, it can be confusing when people talk about gold being a deflation hedge. I like to talk about gold being a default hedge, because if you get deflation, which, by the way, we never really get, there's a lot of talk about deflation, but we never really get deflation. There was a deflation in the 1930s, but then again, we're on a gold standard. That was a whole different situation. But if you consider deflation, by the purest definition, deflation is going to be a decrease in the amount of money. A lot of people are going to consider deflation to be falling prices, but the falling prices are going to follow from the deflation, which is the decrease in the amount of money. Now, you can take a lot of things. Think about houses, new cars. We've had a lot of periods of reported deflation or deflation scares, but if you think about it, the price of a car has pretty much always gone up. I think it's now almost 20 grand for a smaller car. It's going to be over 30 grand for a larger car. What was that price 10 years ago? What was it 20 years ago? What was it 30 years ago? So I don't see any deflation there. So deflation is pretty much a bogeyman that never really comes into play. Now, if we're talking about deflation to the point of default, in other words, they contract the money supply, and because they do that, there's so many debts out in the system, then there's not going to be enough money circulating to pay off those debts. And then you're going to begin to see cascading defaults. Now, if you see cascading defaults come through the system, then the way that gold is going to rise in value, it may not rise in nominal price, but it will rise in its value relative to other things, is that as other things default, those debts are evaporated. Gold will not default because it's no one's liability. So as a percentage of all the assets that are out there, it becomes worth more because it's other things are evaporating and going away. So gold becomes more valuable in a deflationary situation like that as debts begin to default away, even though nominally the price may not rise. Now, do I think that's going to be the case? No, I don't think that's going to be the case. I think they're going to print money until gold goes to 10,000, then 100,000, then a million, then whatever, 10 billion, Weimar type hyperinflation. But if they did decide to bite the bullet and have a deflation, then yes, gold's price nominally could go down until things started to default. That would probably stay even or rise nominally, but it certainly would increase in value a lot relatively to other assets. So I hope that answers that. The Fed funds rate kind of shows that this implies deflation, but I don't think that we're going to get that. They've already gone into their other types of shenanigans, such as Operation Twist and all the other things that they do to print money. And we're going to look at that because I want to examine the latest Jim Willie that came out today, which is really a blockbuster. So I want to read some parts of this because he goes into the recent Libor scandal. And we're going to start with Libor. He says, Libor connected to interest rate swaps. The annual, now chronic, $1.5 trillion U.S. government deficits must be financed. They should be financed at a Spain-like 7% yield. The two nations have equally wrecked finances and an equal unemployment rate. But doing so would be far too disruptive. But doing so would be far too costly. But doing so would take away the wellspring of cheap money for the speculation. The big banks enjoy a brisk carry trade off the U.S. Treasury curve that makes easy profits. No other industry is granted such risk-free profits. So enter the IRS swap to generate an artificial U.S. T-bond rally from a phony engineered flight to safety. The thought of a flight to safety of a massive uncontrollable U.S. toxic debt pit is laughable on its face. The Libor price rig has enabled virtually free funds for the IRS swap that supports the vast 0% U.S. T-bond tower. The next connection will soon be revealed. The IRS swaps are fed by the deep source fountain of Libor at virtually free cost. It bears repeating. Too much attention is given to the adjustable rate mortgage feeder process. Not enough is given to the derivatives that are abused by the financial sector in unregulated shadow systems. The big banks have sold too many multiples of credit default swap insurance to the point that both counterparties are dead. No net neutrality is a reflection of reality. Two legless swimmers do not rescue each other in the deep waters. They both drown, just like the bank parties involved. However, the big story in interest rate swap contracts, those arbitrage long-term bond swaps versus short-term bond swaps that enable free money to finance the levers that control the long maturity for the U.S. T-bonds, Anyone who believes the 10-year note fell from 3.6% in 2011 to under 1.8% was from a flight to quality is either drinking Wall Street Kool-Aid or duped by their market flyers or captivated by media propaganda or just plain stupid. The vested interest in watching the 10-year UST bond yield go into ultra-low territory is all very understandable. Many financial asset prices depend on a low benchmark bond yield. But the reality is that foreign creditors abandoned the U.S. government debt auctions. The reality is that primary dealers to those auctions found themselves stuck with inventory. The reality is that an avalanche of U.S. government debt supply could not be handled with absent demand. The reality is that the U.S. government borrowing costs required, if not demanded, ultra-low yields to prevent a worse explosion in deficits. The only true aspect of the flight into U.S. Treasury is that the European sovereign bonds have turned toxic. But the Europeans are far more likely to purchase German bunds, and they have, driving their yields lower than U.S. T-bonds. Some arbitrage has pulled the two to almost equal, evidence that IRS swaps are at work in the bund backyard. The story will come out soon enough how the Libor rate was rigged extremely low in order to facilitate management of ultra-low 0% Fed funds rate and to enable the IRS swaps to do their magic in keeping down the long-term U.S. T-bond yield. The Libor has been and continues to be the feeder system for the IRS swaps that enforce the 0% and 1.5% yields on Fed funds and the 10-year note. The factor is mentioned on financial networks with quick passing and no emphasis. They still sell the flight to safety rubbish story. And then there's more that he gives there about the fascist business model. But I want to read what he said about the metals. Naked shorts on precious metals. For 2 decades, the banking cartel has been selling gold and silver futures contracts without collateral. They are exempted from regulatory action and prosecution as part of some absurd position in national security. As if it's national security that bankrupt entities don't go bankrupt. The practice covers U.S. government gold treasure, long gone, gutted, pilfered. On February 29th of this year, J.P. Morgan alone sold a full year of global silver mine output in a single hour. This is obscene. Compared to several years ago, the big 4 U.S. banks have twice as big naked short contract positions in the precious metals. Refer to J.P. Morgan Chase, Citigroup, Bank of America, and Goldman Sachs. They all have pretty logos. They are not making America stronger. They are extending the criminal financial structures and their lifespan, giving room for zombies to roam. They enable a U.S. fiat dollar currency to continue longer, despite the absent faith and trust no longer held in it globally. A parallel takes place, like with the Alpha Group for naked shorting Canadian mining stocks through their handy outlet Canaccord. If individuals attempted to naked short any futures contracts, they would be prosecuted and tossed in prison, their assets confiscated. The criminality is vast. The true protection from toxic paper contracts and paper certificates is obtained and secured by owning physical precious metals, never in paper form of any kind, best in bullion bars and coins. Quantitative easing and Operation Twist. The magnitude of bond purchase is astronomical, best described as Weimar-like. The printing of U.S. dollars on electronic devices for the purpose of buying U.S. Treasury bonds that the world no longer demands in order to cover the gargantuan U.S. government debts is out of control. The entire process is obscene and loaded with deception. The public and investment community is told repeatedly of a flight to quality and safety. There is neither quality in a Weimar rag known as the UST bond, nor safety in a junk bond with $1.5 trillion in annual deficits put to securities each year. The U.S. Fed does not have in its charter any feature to purchase 70% of the total sale of UST bonds in 2011, for instance. Operation Twist is a grand lie, a deception to cover the monetization of all 30-year UST bonds ever issued. It is a deception to enable foreign creditors to dump unwanted long maturity UST bonds in favor of very short-term UST bills. The foreign creditors are eager to let the clock run out and have these bonds mature. Think exit. If corporations were to issue bonds without the demand of buyers and float them in the market like a huge tributary from a toxic river, they would be prosecuted and their executives tossed in prison. The criminality is vast. The true protection from the hyper-monetary inflation is obtained and secured by owning precious metals, best in bullion bars and coins. And just a huge summary of a lot of the stories that Jim Woolley's been covering lately. It's much too much to cover here, but I'll link the article. You can read it for yourself. So the corruption continues, and of course the corruption is the bankers covering up their bankrupt system. The Fed funds rate clearly demonstrates that their system has imploded. It's essentially dead. They cannot revive it. They can't go lower than 0% interest rate unless they print money. And that's essentially what they're doing. They are printing up money to buy their own debt, the U.S. government debt, to the tune of $1.5 trillion a year now. And they're effectively bankrupt. It's all over but the shouting. And that's going to come very soon. So, as Jim Woolley points out, your only protection is going to be the physical precious metals. They've taken silver down again. I thought that perhaps this trend line was going to be broken and we were going to break out of this long-term trend. You can see it right here. But at this key point, again, as they've done in many key points in the past, they came in and smacked it down right when it was about to break out. So we'll have to wait and see what it does, and if it rallies at some point, we're going to get out of this situation, but we just have to wait and see when that's going to be. And we'll talk to you next time.